Assalamualaikum warahmatullahi wabarakatuh. For financial management group assignment, our group choose a ratio analysis for Hapsense Industries Sdn Bhd. I'm Ismail Yaakob. Will present about the introduction for Hapsense Industries Sdn Bhd. Okay, the background of companies in 1957, Hapsen from the four brothers of the Kidd family and another partners found the Hapseng in the Malay village from Parit Linau Kecil, Bukit Pasir in Batu Pahat, Johor, with a capital of RM 1,500 to sell confectionery including biscuit. Hapseng Berhad is leading in Malaysia, Malaysian biscuit manufacturer and exporter that has been in operation for over 6 decades. Hapsen Industries take pride in its commitment to delivery dishes and nutrition food and products. One of Hapsen Industries flagship product is the Hapsen cream crackers, which has become a household name in the Malaysia and beyond. The company's success can be attributed to its strong emphasis of research and development. Hapsen Industries invest significant of product innovation, ensuring that its offering remain relevant in overcharging market.
Ismail for the introduction about the Hapseng Industries. So next for my part, I will present to you about the current ratio, quick ratio, net working capital, average collection period, fixed asset turnover ratio, and lastly the inventory turnover. So what is current ratio? Current ratio is the measure of a company ability to pay off its short-term liabilities using its short-term asset. It is calculated by dividing current asset by current liabilities. A higher current ratio indicates a better ability to cover short-term obligation and suggests a healthier financial position. Next is quick ratio. It is also known as the acid test ratio. It's a more stringent measure of a company liquidity. It excludes inventory from current assets since inventory may not be easily converted into cash. A quick ratio is calculated by dividing quick asset by current liabilities. A higher quick ratio indicates a stronger ability to meet short-term obligation without relying on inventory sale. The next one is net working capital. It represents the difference between a company current asset and current liabilities. It reflects the amount of capital available to fund day-to-day operation and is an indicator of a company short-term liquidity. Positive net working capital suggests that a company has sufficient current asset to cover its short-term obligation. Average collection period. The average collection period measures the average number of days it takes for a company to collect its account receivable. It is calculated by dividing the average account receivable by average daily sales. A shorter average collection period indicates that the company collects its receivable more quickly, which can improve cash flow and liquidity. Next one is a fixed asset turnover ratio. The fixed asset turnover ratio measures how efficiently a company utilizes its fixed asset to generate sale. It is calculated by dividing net sale by average fixed asset. A higher ratio indicates that the company is generating more sales from its fixed asset, which implies better asset utilization and productivity. And the last one is inventory turnover. The inventory turnover ratio measures how efficiently a company manages its inventory by assessing how quickly it sells its inventory and replaces it. It is calculated by dividing the cost of goods sold by the average inventory. A higher inventory turnover ratio suggests that a company is selling its inventory quickly, which can indicate effective inventory management and cash flow. So next, I will pass the presentation to the Mr. Zami. Thank you.
All right. First of all, thank you to Encik Muhammad Faiz. Today I will discuss or present about leverage ratio. Okay, in leverage ratio, it divided to three ratio. One is debt ratio, then debit to equity ratio, and time interest earned. All right. First, what is debt ratio? Debt ratio is a metric that measures a company total debt as a percentage of its total asset. A high debt ratio indicate that a company is highly leveraged and may have borrow more money than it can easily pay back to the debtors. So debt ratio, it has a formula. The formula is debt ratio equal to total of the debt and divided to total asset. Okay. Secondly, the debt to equity ratio. The debt to equity ratio is show how much debt a company has compared to its asset. It is found by dividing a company total debt by total shareholder equity. A higher debt equity ratio means the company may have a harder time covering its ratio covering its liabilities. A debt to equity ratio can also be expressed as a percentage. Okay. Then time interest earned. What is time interest earned ratio? The time interest earned ratio measured a company ability to service its interest, to pay back the interest expenses obligation based on its current operation income. Otherwise known as the interest coverage ratio, the TIE ratio had measured the credit health of a borrower. Alright. Secondly, I will present about profitability ratio. Okay. In profitability ratio is divided with net profit margin, return on asset ROA, and return on equity ROE. Okay. First, we discuss about net profit margin. Okay. What is the net profit margin? The net profit margin, or simplified net margin, measure how much net income or profit is generated as a percentage of revenue. It is the ratio of net profit to revenue for company or business segment. Net profit margin is typically expressed as a percentage, but can also be represented in decimal form. So it has a formula. The formula is total net profit margin equal to all the revenue minus cost and divided with revenue. Okay. Then return on asset or ROA. Okay, what is ROA? Return on asset is a profitability ratio that provide how much profit a company can generate from its asset. In other words, return on asset ROA measured how efficient a company management is in earning a profit from their economic resource or asset on their balance sheet. Okay, ROA also have a formula. The formula is ROA equal to net income, all the net income divided with total asset. Right. Thirdly, return on equity ROE. ROE is the measure of a company net income divided by its shareholder equity. ROE is a gauge of a corporation profitable and how efficiently it generates those profit. The higher ROE, the better a company is converting its equity financial into profit.
Assalamualaikum warahmatullahi wabarakatuh. My name is Narizam bin Zahadan. My student number 2021483006. My part conclusion liquidity ratio both the current ratio and quick ratio show an increasing trend from 2020 to 2021 and remain relatively stable in 2022. This indicates an improvement in the company ability to meet its short-term obligation. The current ratio is consistently above one suggestion that the company has sufficient current asset to cover its current liabilities. The quick ratio, which include inventory from current asset, also demonstrate a healthy liquidity position. Efficiency ratio. The average collection period (ACP) has been increasing over the years, indicating that it takes the company more time to collect its account receivable. This may suggest a potential issue with credit management or customer payment delays. The fixed asset turnover ratio show is slightly decreasing trend from 2020 to 2021, but increase in 2022. This implies that the company is generating more revenue from its fixed asset in 2022 compared to the previous 2 years. The inventory turnover ratio remains relatively consistent over the analysis period, indicating effective management of inventory level. Leverage ratio. The debt ratio show decreasing trend from 2020 to 2021, indicating adapting in the company reliant on debt financing. It remained relatively stable in 2022. The debt to equity ratio remained consistent from 2021 to 2022, suggesting a balanced capital structure with moderate debt. The time interest earned ratio is decreasing over the years, which may indicate a decline in the company ability to cover interest expenses with its earnings. This could be a cause for concern and request for further analysis. Profitability ratio. The net profit margin showed the declining trend from 2020 to 2022, indicating a decrease in profitability over time. This could be a result of various factors such as increased costs, reduced sale price, or lower revenue growth. But return on asset and return on equity demonstrate a decreasing trend, indicating a decline in the company's ability to generate profit from its asset and shareholder equity. equity. Overall, while there are positive aspects such as improved liquidity ratios on stable leverage ratios, there are concerns regarding baseline profitability and declining efficiency in terms of collecting period. Further analysis of the company operations, cost structure, and market condition is necessary to fully assess its financial performance and identify area for improvement. So thank you.